So here we are with tax policy and opportunity zones. I'm going to bring our panelists up on stage here. John Lettieri did a pretty nice job of setting the stage early on in his keynote address. He touched on some of the topics that we're going to be exploring in a lot more detail on today's panel, which is tax policy and opportunity zones. So I want all of the investors in the audience today, gentlemen on the panel right now, to be more comfortable with opportunity zones at the conclusion of this panel. So hopefully we won't scare anybody off, but I do want to address some concerns that people have about the impending tax policy changes that are on the horizon. And just to introduce my panelists one more time, give them a proper introduction. Shay Hawkins, hello. He joins us today from the Opportunity Funds Association. He was formerly tax policy advisor to Senator Tim Scott, and today he continues to champion the OZ initiative, and he's very active on Capitol Hill. Shay, say hello. How are you?
How's it going, Jimmy? Thanks for having me.
Fantastic. Thank you, Shay, for joining us. We also have Kunal Merchant here with us today. He's the president and co-founder of Cal-OZ, an advocacy group for opportunity zones in California. Kunal, how are you doing today? Good to see you.
I'm doing well. Thanks, Jimmy. Happy to be here as well.
Excellent. And finally, last but not least, I'm going in alphabetical order, by the way. So John Sciarretti, partner at Novogradac, a national professional services organization, one of the leaders in opportunity zones. And John is also the coordinator of the Novogradac Opportunity Zone Working Group, also very active on Capitol Hill with their advocacy. John, how are you doing today? Good to see you.
Sorry about that.
Quick mic check. There you are.
Thanks for inviting me.
Good. Absolutely. Great to see you. Great to see all of you. So I wanted to go through very quickly, and hopefully this doesn't bore anybody, and especially doesn't bore my panelists too much, but I did want to go through a very quick opportunity zone investing for beginners presentation, just because we have got a fair number of people in the room who are pretty opportunity zone savvy, but I think we've got a fair number of people joining us today who are just learning about opportunity zones for the first time very recently and really just need a quick rundown. So I'm going to try to go through this in 3 minutes or less. So opportunity zones for beginners really quickly here. There's 3 benefits for opportunity zone investors, and it starts when you trigger a capital gain. It can be from the sale of stocks or real estate or anything else that triggers a capital gain. It can be long-term or it can be a short-term capital gain. That capital gain is then subject to 3 benefits. One is a deferral period. You don't have to recognize the gain until the end of 2026, which means you actually don't owe tax on the gain until April 2027. Number 2 is you get a reduction in the amount of capital gains that you're able to recognize by 10%. Quick note, that benefit actually expires at the end of this year. And benefit number 3, and this is really the big one, this is why we're all here today pretty much, is there's no capital gains tax on any OZ gains after achieving a 10-year holding period. So you can dispose of your OZ investment 10 years after making the investment, and it's tax-free. We'll run through a quick example. Let's say you've got a $10 million capital gain. We'll assume a 23.8% federal capital gains tax rate. We're going to ignore state just to keep it simple here. Normally, you'd owe $2.38 million in tax liability the following April, which would leave you with only $7.62 million net. But instead, let's say within 180 days of recognizing that gain, you invest that $10 million in a qualified opportunity fund. So benefit number 1 is a deferral period. And note that you don't get the after tax, you get the full amount. You're able to pour in the full $10 million into the QOF, the Qualified Opportunity Fund. It's essentially a $2 million and change interest-free loan from Uncle Sam. And the important thing to note, though, is that that tax liability on that gain does come home to roost eventually, and the 2026 tax rate applies then. We don't know where tax rates are going to go, and that's what we're going to be talking about throughout the course of this panel. Tax rates could rise. Most expect that they will, but this could actually be to your benefit in the long run. When we get to benefit 3, you'll see why. Benefit number 2 is a reduction. Essentially, you get to reduce the amount of gains that you recognize by 10%. So the $10 million gain is reduced to $9 million essentially. And again, you will have to pay that the tax on that initial gain in April 2027, but it's only $9 million a gain instead of 10. Benefit number 3, again, this is the big one. You pay 0 tax on capital gains realized from the OZ investment after a 10-year holding period. Tax-free growth within the opportunity zone investment. So let's say your $10 million appreciates to $50 million. That's a $40 million gain. Normally you'd owe quite a bit of money to Uncle Sam and possibly your state as well if they have a capital gains tax rate, or if you have nexus in a state that does have capital gains rate. In this case, 0. Note that the gain must be recognized by the end of 2047. If tax rates go up, this benefit actually becomes much more valuable. So I'll skip through a couple of these slides here, but essentially opportunity zones applies at the census tract level. It's a place-based policy covering over 8,700 census tracts. Over 35 million people live in these tracts. And you can see that map right there shows that there are tracts all over the country to invest in. So that's a very brief overview, OZ 101. I hope I did okay, gentlemen, but let me turn it over to you now. You guys are the real experts here in this space. I wanted to get a sense from you guys, ask the first question of the day here. Since we're focusing on tax policy changes, I want to ask each of you, and I'll just go through an order here. What are the tax policy changes that are likely heading down the pipeline? And are they regulatory changes or are they legislative changes? Shay, I'll turn it over to you first to get your thoughts, please.
Well, thanks, Jimmy, for that overview. First of all, it was pretty thorough. I thought we were going to have to spend 20 minutes with Kunal, John, and I correcting that, but that was pretty solid.
Good.
I'm obviously open to any adjustments or additions or corrections from John or Kunal, but in a broad sense, in terms of potential tax changes, of course, the opportunity zone policy is structured around capital gains. And as you mentioned, capital gains are, kind of in the news now. The Biden infrastructure / job creation plan calls for a number of new tax increases to help offset the cost. And one of those is essentially a doubling of the statutory capital gains tax rate. And so, the overall view on that, a capital gains tax increase wouldn't be a part of a theoretical bipartisan infrastructure plan. And so that's out there. But if they can't get bipartisan cooperation and they can't get any Republicans on board, then the Democrats can move forward with a process called reconciliation, which is basically a complex parliamentary and budget process that allows major legislation to pass the U.S. Senate without, with just 51 votes, which the Democrats have. And so if they use this process, then the bill will be a lot more aggressive in a lot more ways. And one of those ways, it will make sense for the Democrats, if they do reconciliation, to raise the capital gains rate. And when I say make sense, I mean, there's a lot of revenue to be drawn in terms of tax revenue from raising capital gains rate, especially if they raised it, especially if they doubled it. But then also, the constituency, if you will, that pays capital gains, particularly, people who are perceived as wealthy, are kind of easy targets in this environment. And so it's not a guarantee that you'll see a reconciliation bill, but if you see a reconciliation bill for infrastructure, then you will very, very, very likely see that capital gains tax increase. And so, fortunately, you haven't heard a lot of rhetoric around sort of closing loopholes in connection with, I almost don't want to say it out loud here because I don't want to give any of the staffers on Capitol Hill any ideas, but you don't hear a lot of discussion of saying, okay, we're going to raise capital gains, but then we have to do the following, 3 to 5 things to make sure that there's nowhere for those capital gains to go, as it were. And so, on the surface, we would see a capital gains tax increase, and that could make opportunity zones an even more attractive location for realized capital gains. If you do see, some type of adjustment, to sort of make sure that those capital gains are kept in the treasury, if you will, the tax associated with those, then obviously that could be, that could be bad. That could lead to some unhelpful changes, but I haven't seen anything on the horizon. In the past year, and just so far in this year, 2021, since the new administration has taken over and since the majority switched over, I've testified in front of Congress 4 times. And so twice in front of the Energy and Commerce Committee, once in terms of, and twice, once in front of the Energy and Commerce Committee, twice in front of the House Oversight and Reform Committee, and once in front of the Tax Writing Senate Finance Committee. My point is this, is that in each one of those testimonies, about a third of my testimony focused on opportunity zones. And the questioning that I received both from Democrats and Republicans also focused on opportunity zones. And so we didn't see anything particularly hostile during that questioning, when they had one of us, an opportunity zone expert in front of them. And you particularly didn't see anything negative that was associated with this current tax bill. And so that's, that's encouraging because, some of the chief enemies on the Oversight and Reform Committee, the 2 members of Congress who have introduced opportunity zone repeal legislation, Representative Ocasio-Cortez and Representative Rashida Tlaib, were both on the committee. Both mentioned opportunity zones, but neither was particularly hostile. In fact, Rashida Tlaib bemoaned the bipartisan support that opportunity zones had. She said, "I'm done with opportunity zones. Both Democrats and Republicans, are constantly promoting this." And so that was actually positive. And then she also mentioned that billionaires have hijacked our opportunity zones, which sounds negative, but if you really think about it, she's acknowledging that opportunity zones are a positive, and she's, in her mind, a certain segment of the investor population have somehow, perverted them, if you will. In Capitol Hill speak, that's actually not very bad at all. It means good things for us and for the people on this call. And so beyond that, the primary theme that I've heard regarding opportunity zones from the administration, from HUD, from Republicans on Capitol Hill, is the need for reasonable transparency and reporting requirements. And the good thing is we have that in the form of the Impact Act. It's a bill that's a solid industry vetted bill that Senator Sinema and Senator Scott introduced in December 2019. So legislation like that and a comprehensive bill are going to be important to avoid regulatory changes from Treasury. The worst thing that could happen is you get a bad opportunity zone headline, and Secretary Yellen, Treasury Secretary Yellen, feels the need to quote unquote do something about about transparency or the performance of opportunity zones. With the Impact Act out there as a placeholder, when she comes under that pressure, and if we make that placeholder even more comprehensive, then she can point to that and say Congress should pass this comprehensive opportunity zone bill, as opposed to feeling that she needs to do something unproductive from a regulatory standpoint.
Good. Well, hey, Shay, thank you for that perspective and that peek behind the curtain that is Capitol Hill. Kunal, I want to turn to you now. I'll pose the question again. What are the tax policy changes that are likely heading down the pipeline in your mind? And do you think they're going to be regulatory or legislative?
Yeah. So I mean, obviously, Shay is incredibly knowledgeable. I mean, the short answer is both, right? So on the legislative side, there's a discussion about capital gains, independent of opportunity zones that's going on right now, either as a pay for the infrastructure or just as a revenue generator generally. Um, One thing I think we should just get out there, which I think Shay kind of alluded to, is just there was concern perhaps at the beginning of the administration or the change in the Congress, would opportunity zones survive at all? And the answer is yes. So for investors who have to make these long-term bets with their earnings, it's very, very unlikely that the program would somehow get abolished. There's going to be legislation always introduced on either side of the aisle that's probably sometimes more symbolic than substantive. I wouldn't put any stock in any of these bills that are claiming to end zones or end the program. It does have bipartisan support. There's just not a path for the legislature to end the incentive. Senator Scott and Senator Sinema with the Impact Act is a critical piece of this puzzle, this reporting piece that is missing. That was missing in the original legislation because of mainly a technicality of how reconciliation works, but was never remedied after that by either Republicans or Democrats. And it leaves the program vulnerable to criticism in the sense that we don't fully understand what the money flow is, where it's going. The reporting requirements are relatively lean compared to other programs. In some ways, that's a good thing because it's sort of a less of an inhibitor for investors trying to do this or project sponsors trying to get their projects forward. But it does leave it open to criticism that this is some sort of program that doesn't account for the dollars that are being, alleged to be going to impact. So hopefully, Senator Scott's bill makes its way through the Congress. Shay would obviously know better than me. Beyond that, there may be other, tax policy changes generally with, tax rates, marginal tax rates, that sort of thing. But Shay alluded to another important mechanism, which is the administrative regulatory mechanism. So Congress is one lever to create change. The other is just the executive office of the president, what the Treasury can do, what the IRS can do, what other agencies, even HUD can do. There's administrative regulatory changes they can make to, change the forms that people fill out when they're doing their tax returns on a daily, on an annual basis, or just other things related to opportunity zones. I suspect that over the course of the next few months, maybe year and a half, we'll see some adjustments to those coming out of Treasury, coming out of the IRS, similar to how we had in the Trump administration initially. However, I have not gotten the sense that in terms of the rank order preferences of the Biden administration right now, opportunity zones are super high relative to COVID, relative to infrastructure, relative to other priorities. So it seems like their hands are full with other topics at the moment. So, for investors who are trying to make bets on, whether to do this or not, I would, it's easy to say it's not my money, it's your money, but I think that the system as set up right now is probably going to stay intact. To the extent there are changes, they'll be around the edges. I think the big one is the capital gains question, but I know at least, one analysis by UBS about a month ago concluded that even if cap gains go up to 43.4%, which would be a pretty significant increase from the status quo, it would still make more sense to put your money into the OZ program, and you'll get a higher net present value of returns compared to paying those capital gains taxes today. So given that that really high capital gains rate is unlikely, and this analysis is saying it's still going to be worth, paying later and getting the deferral, I feel like the regulatory changes shouldn't be something that inhibits or deters anybody here from moving ahead with an opportunity zone project.
Excellent. Thank you for your perspective, Kunal. And John, I want to hear from you now. These two are hogging up all the airtime here. Let's get to John here. I want to hear John again. For those of you just joining as a partner at Novogradac, and he's also the coordinator of the Novogradac Opportunity Zones Working Group. John, what's your take? What tax policy changes do you see heading down the pipeline? And I'll also ask you a follow-up question. What impact do you think these tax policy changes may have on opportunity zone investors?
Well, specifically, the Biden administration released their Green Book, which is their revenue proposal, and some of the titles in that Green Book that may affect opportunity zones, which in general, higher tax rates, corporate rate, the proposal was to go to 28%, which we haven't had to date much institutional investment in the program, and it seems to be picking up. At least in my world, I see more institutional investors, but obviously a higher tax rate would give them more incentive to invest in opportunity zones. And then what Shay and Kunal mentioned about the individual rate, the proposal was to go to 39.6, which in effect would make new opportunity zone investments at that rate a higher incentive, deferral and the back end gain forgiveness. Of course, investors that have already invested at 28%, which you alluded to, Jimmy, if that rate should change and survive through 26, you would have a higher tax rate on that realization of the deferral. But assuming it stayed in place through the 10 years, based on our math, it's still a beneficial investment. To invest or to keep your investment. We looked at some opportunities to sort of realize an inclusion event at the lower rate before any tax change would take effect. And the only opportunity in the tax code now or in the regulations is that if you were able to get a distribution of your investment and you didn't have basis when you got that distribution, which is pretty typically distributions come in the form of debt finance distributions, and typically the investors have basis in that debt, and so they don't realize an inclusion event. But the regulations say today that if you have an inclusion event as a result of a debt finance distribution, that you still keep your 10-year hold benefit. So there are ways you can manage that through some sort of related party debt, which I won't get into now, but we had actually asked. It's probably a statutory change, but we did ask for a regulatory change to allow this sort of election to realize your gain at that lower rate before any tax changes. So definitely the tax changes would affect current investors and future investors more favorably. Another provision in that revenue proposal was to tax capital gains in the event of a gift or death. So currently the law is that basis transfers on a gift, and at death, an investment would be the basis would be the fair market value at death, and decedents escape any taxation on that fair value over basis. In the proposal, there's a provision which proposes to tax that unrealized capital gain at death or gift. So obviously that would affect opportunity zones, in that death is not an inclusion event today. So if you hold an opportunity zone investment, and a decedent would pass that benefit on to its heirs without any tax or inclusion at death, in the holding period is in tax. And so if someone were to pass away in the 6th year of investment, then the beneficiary would only have 4 years and then they could actually realize the 10-year hold benefit. Of course, this provision to tax capital gains would take that away. And there probably wouldn't be the ability to defer those gains again into an opportunity zone investment, because in order to defer capital gains into an opportunity zone investment, you have to have a sale or exchange, which by definition, death is not a sale or exchange. And it has to be an unrelated party, and typically, beneficiaries are related parties. So we're not sure how that would play out, but there is a provision in that proposal that says that 1202 or small business stock benefits are not erased or are not taxed on a decedent. And so our opportunity zone work group is watching it closely. We want to make sure we get out in front of this and hope to have an exclusion for opportunity zones as well. along with the 1202, it makes sense that decedents that invested with the thought that they, could realize the benefit, even though they passed away, that they, that they get to keep that benefit. And then the last issue in the last title in that proposal was the elimination of like-kind exchange. I think it's over $500,000, so that's the only deferral that you can. Any deferral over $500,000 would no longer be available. So that limit on the like-kind exchange obviously would make opportunity zones the only game in town for deferral in around real estate. Obviously, you have the small business stock deferral, but so obviously that proposal, if it were to go through, would make opportunity zones more popular. Again, they're all proposals. Shay sort of laid out the landscape that I think it's a tough challenge to raise taxes. I think the capital gain tax, I think it's been over 50 years where it's had a preferential rate, and there's been proposals over those years to make it the same as ordinary rate. And so, it's like I said, it's a tough road to hoe for Congress to be able to increase those capital gains rates.
Yeah, but it is what a lot of people are expecting to come down the pipeline at some point, right?
Yeah, I think it's probably more likely they go up, but not to 39.6%. Where you would still have a preference for capital gains. We're the economy is recovering from COVID. That just makes it a tougher challenge for the administration to raise those rates.
Yeah, fair enough. Well, in any case, though, I do think we are expecting them to go up at least a little bit. Maybe not as high as Shay alluded to. Maybe not to ordinary rates. And what I hear from investors a lot of the time, and I'm sure John and Shay and Kunal, you hear this as well, is, hey, why should I invest in a qualified opportunity fund? I can just lock in my 23.8% rate right now and be done with it. Whereas otherwise, I've got to defer that gain recognition, and I'm going to be paying who knows what at the 2026 rates. And I think it spooks off some investors. So I just want to drive the point home one more time that, John, as you alluded to, the rates going up actually still has a pretty substantial economic benefit, especially when you take into account that third benefit that I ran through in my OZ 101 intro. It makes that exclusion event on the back end, that those tax-free profits from opportunity zone investing, much more powerful, I believe. Any other thoughts from you guys on that?
No, I agree with you. I mean, I think we analyzed it. If rates were to go up to 39.6%, which actually ends up being 43% because of the investment tax that you pay.
Right.
That depending on whether they stay there in 26, which could be another administration and another tax policy, and depending on what your appreciation is. So I think we looked at it where you sort of double your investment, you're still ahead.
Kunal, thoughts from you?
Yeah, I mean, I was persuaded by that. There was this UBS report that came out in early June that basically made some assumptions that if there was a $1 million gain with the 10% capital gain exclusion, and the break even was 43% at a 7% discount rate and a 7% CAGR. So it's a math problem, right? Like, are you better off taking the hit now and then having the certainty, or do you take the deferral going forward? A lot of it is project specific, like John said. But if you believe in your project, you believe in the appreciation, I don't think the rates will get up to 43%. So I personally, I do think it's still okay to move ahead on an OZ project, but every project is different. There may be some unique factors that may motivate some folks to act differently, but I think on the whole, it's safe to proceed.
Good. Shay, any thoughts from you?
Well, first of all, I'm allowed to take a good portion of John's time in each cycle because I'm part of the Opportunity Zone working group for Novogradac. So as a working group member, I could always take a little Novogradac time, But no, I think, what really stood out is And one thing that I failed to mention was the gift and tax potential impact that John noted. You know, because then you're in a situation where there's going to be a significant portion of the investor class that's just literally that has a forced capital gain, you know, and has to kind of deal with it. And so, you know, I think that could be, you know, a positive driver for, you know, for these investments overall. And then, you know, I tend to agree. I mean, and I don't think, you know, a capital gains rate going to 30% or, you know, or 28% or something like that. It's not, you know, it's not gonna, you know, cause $24 billion in, you know, new investment to, you know, to drop to 6, you know, over the next 3 years, you know, but, you know, and it could be that the combination of changes that are in the ultimate, you know, in the final reconciliation bill, you know, are neutral to positive for opportunity zones. But you know, we'll just have to, you know, as John said, just monitor it day to day, and just make sure that, you know, in a perfect world, we would get opportunity zones excluded from, you know, the potentially damaging changes, and you know, and then benefit for, you know, from some of the other potential changes. And there's good precedent, if you will, you know, for getting, you know, for getting opportunity zones treated a little differently, in that we have had bipartisan opportunity zone oriented legislation on tax with the treatment of Puerto Rico and their designations. And then also, you know, we have seen some positive regulatory changes for opportunity zones related to COVID. Now, granted, those happened under a different administration, but you know, the nature of those regulatory changes were not challenged by quote the other side during that time. So you know, it seems like there's a recognition that opportunity zones are key to us recovering from the pandemic, and we want to treat them, you know, treat them in a way that allows it to continue to be an incentive.
And Jimmy, I know we're almost at time, but Shay kind of hit a really important point, which I think is good for folks out there to look at, which is one area that seems to be less contentious is the idea of aligning policies with the zones. So irrespective of the conformity, the tax benefit, both sides seem to be comfortable with the methodology of saying, hey, this geography, which is now an opportunity zone tract, is worthy of increased attention. That seems to be bipartisan. So as you're looking at your projects, be on the lookout for changes to federal and state policies that are not trying to align more tax incentives, more subsidies, more public policies generally to incentivize and benefit projects that are being in designated opportunity zones, irrespective of the tax benefits. So there may be other ways to improve your project with state and tax, and sometimes even local policy. That's a trend we have been seeing. So just beyond the capital gains piece, be on the lookout for that as well.
Yeah, really good point. I did want to, I think we're actually at time right now, and I want to take a break, but I did want to get to a few questions. So let's go for a few more minutes if you gentlemen have time. Our next fund pitch, excuse me, will be starting at 11:45 a.m. Eastern time in about 9 minutes. David asks, can you talk about proposals for raising capital gains and eliminating the 1031 exchange? I don't know if we've talked about 1031 yet, but what are your thoughts on whether or not that may be on the chopping block? This is going to be rapid fire, so whoever wants it.
I mean, the only indication we have is the revenue proposal, right? Which does indicate that there would be limits to the 1031 of only $500,000. What was the other thing? Other than
he wanted to discuss proposals for raising the capital gains rate. I think we've discussed that.
yeah, that's Green Book proposal.
Yes.
Yeah.
Yeah, I don't know about you, but I don't think there's enough votes to get rid of 1031 in Congress. Is that right?
Yeah, Shay, yes or no? 1031s on the
Very,
topic.
very unlikely that 1031s are eliminated. If they did, it would only help opportunity zones, but very unlikely.
Agreed. Dane asks, would the end of year 2021 capital gains providing step up of 10% possibly be expanded into 2022 due to the delays and events of the past 15 plus months? So again, that 10% basis step up or 10% capital gain recognition reduction, that's expiring at the end of this year. Gentlemen, any chance that could get extended into 2022 and beyond? Shay, you go first. I know you've got a good one for this.
No, just that would be a part of a comprehensive opportunity zone expansion bill. So you would lay a foundation of you would lay a set foundation around transparency reporting, because there's bipartisan support for that, and the Biden administration has indicated that that's a priority. So that's the foundation, and then you overlay things like, extending the 10% step up in basis, extending the policy overall, allowing governors to designate additional zones, those kinds of things. And so a comprehensive bill is a possibility, and it's important to have something as a placeholder, because even if you don't get it passed this year, it's out there for future vehicles. And also it takes the pressure off of the potentially negative regulatory steps that Treasury or IRS might take.
Yeah, there's a proposed bill out there, right, to extend to 28, which that's how you'd end up getting the step ups, because you'd end up holding your investment
Right.
for the required 5 or 7 years.
Kunal, any thoughts there?
No, I think they hit it.
Excellent. We've got a couple more questions here I want to get to. I think we're going to blow right through the break, but that's okay. That break's really just for me. I don't need it. I'm good. So let's see here. We've got one. We got another one from Dane, actually. He asked a technical question. Isn't the Senate only allowed to use the reconciliation process for two bills each year? And with each of these, there needs to be a budget resolution. If that's the case, what is the rank order of capital gains tax increases being one of the two bills? And also, if the capital gains tax increase is put into place, this should get people off the sidelines and realize capital gains now, and will need to redeploy into other investments. What do the panelists see as an alternative for deploying capital gains on any assets? Because eventually people do need to realize those capital gains.
Right. So in short, there's another reconciliation bill that is possible this year. Tax policy, everything they want to roll into it, from the international changes to an international tax policy, everything we're talking about on the individual side, a potential increase in the corporate rate, would all be rolled into one reconciliation bill, because it's like herding cats. You got to get all of the majority on one page at one time. So you wouldn't try to split that up. You would do it in this next bill.
Thoughts from Kunal or John on that question, or did Shay hit it?
I think you hit it.
Okay.
I think even in reconciliation, there's the Manchin wild card, right? That's, so it's not a given.
I've got a few stump the accountant type questions here in the chat. I may address you with these, John, so watch out. The previous speaker from Urban Catalyst, Eric Hayden, mentioned he mentioned a fourth tax benefit, which was the elimination of depreciation recapture. This question asks, let's see, basically depreciation from investment held 10 years becomes permanent and can be used to offset ordinary income. Would this influence your decision to choose a QOF that reports on a K1 versus a 1099?
I guess it would, because a 1099, I guess what we're talking about a REIT, right? So you don't have any pass-through losses. So yeah, that's a huge benefit in that, under general tax law, any depreciation you take is recaptured at a higher rate. For individuals, it's 25 versus 20 for capital gains. So what the opportunity zone regulations gave us is that you step up through that as well as the additional appreciation. So it's a huge benefit investing in real estate through opportunity zones.
And then I'll hit you with one more, John. Also, this one comes from Robert in our live audience. If a married spouse sold stock owned personally, does the opportunity zone investment need to be with that spouse, or can it be a joint purchase and they file taxes jointly, he says?
Yeah, if you file jointly, then it would be that taxpayer, the joint taxpayer.
Good. Let's see if we have any other questions here. I think we might wrap it up there, actually. Give myself a couple minute break before the next panel starts. I want to thank everybody again for joining me, John, Kunal, and Shay. Thank you for all of your insights today. We'll stop with Stump the CPA there. And thank you, everybody, for joining. We'll get resuming with the programming in just a couple minutes here. Nest Opportunity Fund is up next. Thanks, guys.
Thanks, Jimmy.
Thank you.
Thanks, Jimmy.